So, aloha and welcome everyone. Today we're going to discuss if private equity is in a bubble or not, and also clarify what the private equity is. So firstly, we're going to start off and tell who we are. So we have from Italy, in Milan right now, Francesco Gori, who is majoring in finance. We have me from Sweden, and I'm in Stockholm right now, who is also majoring in finance. We have Henriette Resen, who is from Oslo, Norway, who is majoring in finance and international business. And also Mikkel Solbakken from Oslo, Norway, who is majoring in finance and BCIS. So let's start off. What is a private equity? Private equity is an alternative investment class and the form of private financing that is neither listed or active in the public markets. Instead, the investments are made by private investors and in the private equity company, which in itself invests or buy parts of companies that needs access to capital. The private equity firms have funds for different companies and sections where the investors' money ends up. And from there, they buy shares in companies. The investments made in private equity are primarily made by institutional and accredited investors, as these can set aside significant sums of money over longer periods. And this is very necessary as there is a long wait for the holding period that is usually between 3 to 10 years. And when the companies can either buy out themselves or if the investors can sell their shares in the company further, the goal of the investment is achieved and the private equity company can distribute the profit to the investors. So let's go over to what is an IPO. And Francesco, can you tell us what that is?
Yeah, sure. So an IPO is a process with which a private company become public. There are three different types: traditional, SPAC, special purpose acquisition companies, and direct listing. The pro on going public is it's easier to access capital in the public markets, and there is the possibility of huge returns for early investors that they can sell their shares on the public markets. The cons are a long and very expensive process and more rules and disclosure agreements in the public markets than in the private markets. But let's see in the next slide the difference between SPAC and IPO. So the SPAC, it's a new type of IPO. It's not really new, but they start using it a lot since 2017. And it's an easier process. Now it's 70% in 2021 of all the IPOs market. And we'll see in the next slide why they are starting using it, all the private companies. So in the traditional IPO, the private company is making a deal with an investment bank to underwrite them and to evaluating them and to set an initial price in the public market. Usually this initial price, it's a bit overvalued. And so the public investors are missing some returns on the investments of IPOs companies. And then it's a 6 month, 1 year and more process. So it's really long and there is literally really a lot of work to do, of legal and accounting statement required. So it's a really heavy process. The special purpose acquisition companies, it's way easier, 3 month processes, and consist in some investors, some people that are creating a SPAC company that is a company without a business, but that it's traded on the public markets. This company has 2 years to merge with a private company. And the SPAC, the initial price, it's $10, and then it's going up and down by the performance of the private company that they want to merge with. So that's also a good way to not have an overvalued initial price and to let public investors to gain returns on the investment. And yeah, but in the next slide, you see that the numbers of IPO is going down. In the last 20 years went down a lot. That's because it's easier to raise money in private markets, and because there are more rules and obligation in the public markets. So a lot of private companies are deciding to stay private longer, and that is creating a really big private companies. And that could be a problem because it's increasing also the number of LBOs, so leverage buyouts. But yeah, and we can talk about the deal of the IPOs that is increasing with Mikkel, that will talk about the prices and the deal size of private equity.
Yeah, so I've been reading a lot in the Baines report, which is a private equity report. Basically, they post what they find, and I've seen some interesting numbers from the private equity market. And the most interesting is probably what Francesco is talking about, the IPOs, and the number of deals are going down by about 1,000 deals less, and the average deal size is way more than in 2019. So there's definitely something to look at, and even though there's about 24% less deals being made, the value generated is better than the 5-year average. So also we're seeing the buyout deals getting larger. We also see that companies, they seek to buy companies that can take a lot of debt, and because of COVID and low interest rates, they have had the opportunity to have a way more or higher purchase price multiply. And it's a bit worrying that it's about 80% of all leveraged deals are above 6 times multiply. And in normal circumstances, I think it could definitely be a warning sign of a bubble. But since the debt is very good right now to have, it's something not too risky to worry about. But yeah, and also just to make you guys have a clear vision of how the private equity market went with COVID. It started pretty normal, and then when COVID hit in February, in the first quarters, it really dipped the market, and you saw that a lot of investors, even in the public market, stopped trading and selling off their shares. So after that, the central banks pumped trillions into the economy to prevent distress in the market, and hopefully it has prevented a recession in the near future. But the market, private equity market, is definitely going better than what analysts thought it was going to go. But most of the buyout deals were made in the last 2 quarters, and it's also transitioning into 2020. So we see a bull market and a good market for private equity right now. So when we're trying to think if it's a bubble or not, I think it's important to think about the dangers of bigger buyout deals. The bigger the buyout deal sizes are, it limits smaller private equity firms access. And also, if the deals doesn't go through and there's a lot of debt, there's also a big chance of market failure. Another thing, dry powder, which is basically money that just sits in the private equity account and assets that doesn't get used. It contributes to management costs and driving demand for acquisitions up, hence driving the prices of the buyout deals a lot. And if they get too big, I don't know how that will look in the future, but that's definitely something to look at. Also, inflation. A lot of money has been pumped into the market, and we might see, now it's a pretty low inflation, but we might see hyperinflation in the future. So lastly, overvalued companies. We see that at least in COVID, a lot of companies are overvalued and might be a sign of bubble coming in the future.
So to sum up, private equity has blossomed over the last decade and is now a lucrative investment. However, there are many signs telling us that private equity might be in a bubble. For example, many purchases are based on belief rather than a thorough analysis. The vision of success and the next big thing is stronger than the financial performances. This has caused an overvaluation. Another sign of a bubble. And any company seen to belong in this narrow group that is perceived to be really valuable is also valued at extraordinary levels, resulting in record high prices. Moreover, since the financial crisis, the ultra-low interest rates have made fixed income assets unattractive, and availability to grow in private markets is higher than the public market. Moreover, the low interest rates have made it cheap to take on debt, resulting in a lot of capital chasing few deals, which also drives up the prices. But on the other hand, many private equity firms has underperformed public equities. So the decline in IPOs, which Francesco talked about, and the high valuation may indicate that it's easier to raise money in the private sector, but that private equity might not be the best choice. All of these factors combined have contributed to the attractiveness of private equity, with an underlying danger of being in a bubble waiting to burst. So I want to ask you guys, what do you guys think? Is that private equity in a bubble or not?
I think it could be in a bubble that is going to be a bit different since the one that we got used in the last years, because private equity is less liquid than public markets or also real estate. I mean, investors cannot sell right away their assets because most of the projects are 3-10 years. And so we will not see, I think, all the investors selling, all the private equity firms like selling altogether the firms that they bought. But for sure, the most concerning things is the deal size of private equity, that they are going up. And so private equity firms are using more debt. They are doing more leverage buyouts and taking more debt from the bank to buy overvalued company, because like Mikkel said, they are overvaluing the company. Can be dangerous, because if the company is not performing well in the next 10 years, or they will not be able to sell the company in 10 years to the price that they target, they will not be able to pay back the debt that they took from the bank. And so that can be dangerous. And if it will happen, that will be the time when the bubble will burst. And one thing that is contributing the most to creating a bubble, I think that could be low interest rates, because the private equity firms are, they can take more debt and easier. And so that can contribute the most to create a bubble, I think. But what do you think, Gustav, about low interest rates?
Yeah, I totally agree on what you say. And I think also that low interest rates is one of the major parts of why private equity can be in the bubble. Because it's easy and cheap for them to borrow money at the moment. And when they can borrow money, they want to invest it. They just don't want to have dry powder, as Mikkel talked about, on their accounts, which costs them some small money, but at least it's not profitable to have money on their accounts. And also I've seen trends that private equity firms have started to invest in more venture capital companies and taking higher risks, because they have the money and they they want to invest and they want to make the next big thing and make money, and which I think can be a good thing and also a bad thing, but it's for sure higher risks, and they're taking high risks because they want to be and make the next big thing. And also, I think also that maybe maybe private equity is in a bubble, or maybe not. But otherwise, I think this is what we're seeing now can maybe be the new price level of the future, and maybe private equity is just so far ahead. So maybe the rest of the world will catch up, and these price levels that we see that have been increasing so much, maybe they set off and start to get stabilized. But I think that's the thing that we will see in the future, and it's hard to say right now. But of course, I think that if private equity is in a bubble, one of the biggest reasons is the low interest rates.
I agree with you. If you just look at the numbers, like the value generated from the buyout deals, private equity market is performing better than what they've done the last 5 years. However, they're taking on more debt, and the deals are getting larger, so the funds needs to make bigger returns on the investments, which might be kind of a risky thought, but I definitely believe it could lead to a bubble, but I don't think there's a bubble that's going to burst in the near future, just because, as we saw in COVID, how good the private equity market can perform even with a lot of distress in the market. And I think private equity came out best out of public and private market after COVID, because they like to take leverage buyouts and use that, but definitely worrying that the deal sizes are getting so large, and that they're overvaluing companies. So I think could be in a bubble in the future, but not 100% sure.
I'm not an expert either, but I think the debt too is a really big problem as an effort to take advantage of the lower interest rates. Firms have borrowed a record amount of money, which can be a warning sign where you don't have any fundamental ground to stand on. But I do agree with Mikkel. I don't think we're in a bubble yet, but a bubble in a private equity isn't inevitable. I think we might get there because there's plenty of room to grow on. But yeah, I'm not an expert, and I don't think we're in a bubble yet, but in the future, we might be in a bubble.
Okay, perfect, guys. I think we will have to end there, and thank you all for your participation and your thoughts of this discussion. And thank you so much, and I'll see you guys around.
Yeah, thank you for having me.
Thank you.